The Internal Revenue Service has been explicit since 2014. Cryptocurrency is property for U.S. federal tax purposes. Every disposal, every sale, exchange, payment, or swap is a taxable event. The IRS has subpoenaed records from Coinbase, Kraken, Gemini, and dozens of other platforms. It has deployed blockchain analytics firms to identify unreported transactions. And it has made the question, did you receive, sell, exchange, or otherwise dispose of any digital asset during the year? A mandatory disclosure at the top of Form 1040 for every U.S. taxpayer. Estimated enforcement actions and settlements related to crypto tax noncompliance have reached tens of billions of dollars cumulatively. For institutional investors, family offices, and registered investment advisors, the stakes are even higher. Not just individual liability but fiduciary responsibility, compliance infrastructure, and investor reporting obligations. This video provides the definitive institutional framework for understanding U.S. crypto tax treatment. 3 foundational principles govern U.S. crypto taxation. First, property treatment. IRS Notice 2014-21 established definitively that virtual currency is capital property. Every time you dispose of crypto, sell it for dollars, swap it for another coin, use it to purchase goods, or transfer it as payment, you trigger a taxable event. Your taxable gain or loss equals the proceeds received minus your cost basis in the asset. Second, the holding period determines the tax rate. Assets held for 12 months or less are short-term gains, taxed at ordinary income rates, up to 37% for high earners. Assets held more than 12 months qualify for long-term capital gains treatment, 0, 15, or 20%, plus the 3.8% net investment income tax for high-income taxpayers. For institutional portfolios with significant gains, the difference between short and long-term treatment can represent millions of dollars in tax savings. Third, the wash sale exemption. Unlike equities, crypto is not currently subject to the wash sale rule. This allows tax loss harvesting with immediate repurchase, a meaningful planning tool that institutional tax advisors should be actively using throughout the year. Understanding the specific rates is essential for portfolio planning. For long-term capital gains, assets held more than 12 months, the 2024 rates for married filing jointly are 0% on income up to $94,050, 15% from $94,051 to $583,750, and 20% above that threshold. High-income investors also pay the 3.8% net investment income tax on top of the 20% long-term rate, for an effective federal rate of 23.8% on qualifying gains. Short-term gains, assets held 12 months or less, are taxed as ordinary income. For high-income institutional investors, this means the top federal rate of 37%, potentially plus state income taxes, which in California, New York, and New Jersey can add another 10 to 13%. Staking rewards, mining income, and other forms of crypto income received as compensation are treated as ordinary income at the fair market value of the tokens on the date of receipt. The subsequent disposal of those tokens triggers a separate capital gain or loss calculated from that receipt date basis. Cost basis accounting method selection has a material impact on annual tax liability. 3 methods are relevant for institutional crypto investors. FIFO, first in, first out, is the IRS default if no method is specified. Your earliest acquired coins are treated as the first sold. In a rising market, this typically means selling the lowest cost lots first, realizing larger gains. FIFO simplifies record keeping but is rarely the most tax-efficient approach during bull markets. Specific identification allows you to designate which individual lots are being sold. By choosing to sell high-cost basis lots first, you can minimize taxable gains. This method requires meticulous acquisition records, each purchase with date, quantity, and cost, but is worth the administrative burden for large portfolios. HIFO, highest in, first out, is a specific identification variant that automatically selects the highest cost basis lots for each sale. Tax software platforms including CoinTracker, Coinly, and TaxBit implement HIFO as a default optimization. The IRS permits HIFO under specific identification rules. For institutional portfolios actively managing positions across multiple exchanges and wallets, HIFO implementation through a dedicated crypto tax platform is the standard practice. 3 high-risk areas that generate disproportionate IRS compliance exposure for institutional investors. First, DeFi transactions. The IRS has signaled, and its 2023 guidance increasingly confirms, that virtually every DeFi interaction constitutes a taxable event. Swapping tokens on Uniswap, adding liquidity to Curve, borrowing from Aave against crypto collateral, all are potentially taxable. Institutions using DeFi protocols for yield generation must maintain transaction-level records and work with tax counsel experienced in DeFi mechanics. Second, expanded broker reporting. The 2021 Infrastructure Investment and Jobs Act dramatically expanded the definition of broker subject to 1099 reporting requirements. Form 1099-DA reporting, phased in from 2025, will generate IRS matching data for a far wider universe of crypto transactions than ever before. This increases detection risk for unreported gains significantly. Third, foreign account reporting. Institutions or their principals with crypto held at offshore exchanges, including some that may not appear to be foreign but are, may have FBAR reporting obligations for holdings exceeding $10,000. FATCA thresholds are higher but carry similarly severe penalties for non-disclosure. The tax calculation for each disposal is formulaic, proceeds minus cost basis minus transaction fees, multiplied by the applicable rate. Walking through a concrete example clarifies the mechanics. Assume an investor purchased one Bitcoin for $28,000, including exchange fees, 18 months ago. They sell it today for $45,000 and pay $150 in exchange fees on the sale. The taxable gain is $45,000 minus $28,000 minus $150, equaling $16,850. Since the holding period exceeds 12 months, this qualifies as a long-term gain. For a high-income investor at the 20% long-term rate, the federal tax is $3,370, plus the 3.8% net investment income tax for an additional $640, and any state-level capital gains tax. Had the investor sold the same position within 12 months, the gain would be taxed at ordinary income rates, potentially 37% plus state, more than doubling the federal tax liability to approximately $6,235. This arithmetic makes the 12-month holding period a powerful planning variable, particularly for institutional portfolios managing large unrealized gains. 5 non-negotiable elements of institutional crypto tax compliance. 1. Implement dedicated crypto tax software. Generic accounting platforms cannot handle the complexity of crypto transaction flows. CoinTracker, Coinly, and TaxBit all offer institutional-grade API integrations with major exchanges and generate Form 8949 output compatible with standard tax filing workflows. 2. Select and document your cost basis method before the tax year begins. The IRS requires consistency, and switching methods is a material change requiring care. 3. Engage crypto-specific tax counsel. Standard CPAs often lack the technical knowledge to correctly classify staking rewards, DeFi liquidity provisions, and complex cross-chain transactions. The stakes of misclassification are high. 4. Implement systematic year-round tax loss harvesting. The absence of a wash sale rule is a structural advantage unique to crypto. Exploit it through a regular harvesting program. 5. Assess international reporting obligations annually and confirm the Form 1040 crypto disclosure is answered accurately. This question creates a sworn representation. Incorrect answers carry perjury risk beyond mere penalty exposure. Tax treatment is one of the most consequential and least understood aspects of institutional crypto investing. Crypto Mechanics provides the depth and precision that professional investors need. Subscribe for analysis that covers the full infrastructure of digital assets, from tax mechanics to custody to market structure.